think the first thing to say is that money moves markets. I think everyone would acknowledge that. So what we do is we piece together a picture that starts with what central banks do. So we look at what central bankers are actually doing, not so much what they're saying. We wouldn't necessarily want to believe them. We're looking at their actions in markets. Then we look at cross-border flows. So foreign money tends to be, in certain markets, critical. Emerging markets are a very good example of that. Money flows into emerging markets often drive emerging market financial markets significantly. And then we look at what the private sector will do in terms of its generation of cash. That might come from corporations building up cash balances. It may be from banks lending. It may be through shadow banks expanding their balance sheets. So all these elements come together and we build up a sort of tapestry of how the global liquidity picture looks. And from that, we can essentially extrapolate how markets will move. Now, the essence of that approach is really to say that the flow of liquidity into markets primarily drives fixed income markets. So in other words, bond markets. It sets the direction of interest rates. The mix of liquidity is much more important for understanding forex markets. So in other words, if the private sector is strong, that tends to be associated with a strong currency. On the other hand, if the central bank is expanding liquidity significantly, you tend to see a devaluation of the currency. And then the third thing is to understand equities, which are probably the more complex of any of the asset classes, because equities are very much a function of emotion as much as the sort of macro space. And so what we're looking at when we want to understand equity market prospects is the positioning of liquidity within investor portfolios. So if there is lots of cash available, equity markets tend to do quite well. If there is low levels of cash and very high equity positions, equity markets tend to do less well looking forward. So we look at the positioning of liquidity for equities, we look at the mix of liquidity for forex markets, and we look at the direction of liquidity for fixed income markets.